This is the January 2026 mortgage rate update. And if you're sitting there thinking fixed rates look decent again, but variable rates are creeping back into the conversation, you're really not imagining it, because variable rates are winning right now. I wouldn't recommend the 5-year fix for anybody, but here's the twist. Are we going to go fixed or are we going to go variable? That's a huge debate right now. Everyone asks me, Alex, what are the interest rates going to do? I wish I had a crystal ball for you all, but I don't. And it all depends on insured, insurable, or uninsurable, purchase, switch, or refinance. If it's a second home, if it's a primary residence, if it's a rental, there's so many determining factors to what rate you get. Two different people can say, well, I got something in the 3s, and one of them, that's a great deal, and the other one gave up probably some flexibility that they didn't even know that they needed. Now, if you're new here, my name is Alex. Obviously, I'm a mortgage broker, but I'm also a real estate agent, and I focus on the GTA West. So quickly, if you want to have any questions about mortgages or real estate, just click the link below and book a call with me, and we can have a chat about whatever you want to talk about. Grab your coffee. Let's go. So quick backdrop here so these numbers actually make sense. As we head into late January 2026, we all know the Bank of Canada is sitting at 2.25%, and prime at most banks is at 4.45%. The next announcement is at the end of January, and I personally believe that the Bank of Canada will hold steady at 2.25%. That's just my thought. We'll see what happens in a couple weeks. Now, we all know variable rate mortgages are built off the prime, and fixed rates are driven by bond yields and lender competition. So even when prime stays flat, fixed rates can move, and that's exactly what we've seen over the last month or so. I can't tell you how many emails I've got with rate updates, and it's just the fixed rates going up or down a couple points. Now, 3-year fixed rate has gotten more competitive, but the 5-year fixed rate, honestly, is not attractive anymore, in my personal opinion, because we really don't know what's going to happen in the next 5 years. Now, who should pay attention right now? If you are in these 3 groups, you should really care about this mortgage update. If you're renewing in the next 6 to 12 months, you finally have options again. So don't panic. There are real options out there for you. If you're in group number 2 and you're sitting above 5%, a midterm switch might make sense, but only if the math works on your penalties. And if you're switching to a lender that allows, it's called a cap. So you can basically cap some of your penalty into your mortgage. And number 3, if you're considering buying this year, especially in the spring, this rate update is for you as well, because you could potentially lock in something now if you want to buy something in March or April. Quick crash course, if this is your first market update with me regarding mortgages, insured mortgages means less than 20% down, owner occupied, and you're getting the default mortgage insurance through whatever mortgage provider, whether it's CMHC or Sagen or whoever. Now, yes, you get the lowest rates because it's less risk for the lender because you are getting insurance, and the more plain vanilla you are, it's fine. Now, if you are insurable, which means you're putting 20% down and you're in the insurer guidelines, so under $1.5 million, you probably in and around the same as the insurable rates. Now, the uninsurable is refinances, rentals, purchases over the insurable limits, longer amortizations, unique or multi-unit properties. And this is where rates are higher because lenders are not greedy, but it's because of the risk. The risk is much higher when you don't have mortgage insurance, because if you default and you're not insured, the lender's screwed. So everything is built off this. Now let's zoom out a little bit before we get granular here. Right now, nationally, there are now 3 main options generally to pick from. 3-year fixed, which is often mid to high 3s on strong files. 5-year fixed, which is kind of attractive if you like stability, but for insured or insurable purchases. Uninsurable, I wouldn't go for that. And the 5-year variable is literally the cheaper than any fixed in most cases, but not by a massive margin. So the real question is, what's not the cheapest today? Or what's the cheapest today? It's how much risk do I want over the next couple years? So you have to ask yourself that personally. Now let's break down these scenarios here. Purchase rates. If you are going to buy something in 2026 and it's high ratio, so it's insured, this is going to be the sharpest pricing right now. Typical ranges that I'm seeing right now, mid-January, for a 3-year fixed insured is in and around the high 3%. 5-year fixed is about high 3s to low 4s. And 5-year variable insured is anywhere from 3.65 to about 4%. Now, these are full feature A-lender products, clean files, good income, good credit. Now let's move to purchase insurable. So you're putting 20% down and you are not getting mortgage insurance, but you're in the insurable guideline. So under 1.5 million, you've got that 20 to 30% stacked up for your down payment, which is fantastic. 3-year fixed is anywhere from 4 to 4.5, and a 5-year fixed, honestly, is higher, and I just wouldn't recommend. But the 5-year variable for an insurable purchase is kind of like the uninsurable, hovering around the 4%. Now, this is what I call the beautiful but boring category. Lenders like these files, and pricing reflects that on the rates. Now, let's move to the purchase for uninsurable, over $1.5 million. And this is where it really starts to spread out, because depending on the property and the structure, rates are higher. Lender choices narrow, and product features matter more than squeezing out the lowest numbers. You'll see 3-year fixed options around the mid 4%, 5-year fixed options in the mid to high 4%, and the 5-year variable is closer to 4%, but you're still, let's say, 4.1 to 4.34-ish. But this is where I sit people down and say, listen, make sure this mortgage doesn't box you in, okay? You have to learn about mortgages before just picking the lowest rate. Now let's move over to switch and transfer. So not a refinance, it's a direct switch. And this is where people get confused, because a switch is the exact same mortgage amount, your exact amortization, you're just moving lenders, you're not pulling any equity out, and the switch pricing is often very competitive, especially because the lender wants your business. Now, if you are insured and you're switching, rates are often very close to the insured purchases. But uninsurable switches, it's still competitive, but it's more lender specific. Now, this is where people accidentally accept restricted mortgages because the rate looks amazing, but the product isn't. So switching is usually when you have leverage. Don't waste it on the fine print, okay? Now, the big one, refinance rates, okay? If you are refinancing and you're pulling out equity, consolidating debt, extending your amortization, you're in this insurable bucket no matter what. Refinance rates are higher than purchases rates. The promos are usually weaker, and flexibility matters a hell of a lot more when it comes to refinance rates. And it also depends what you're getting it for. Is it a primary residence? Is it a second home? Is it a rental? Or is it a rental with 2 to 4 units? Typically, you will see 3-year fixed rates higher than the purchase, so mid to high 4s. 5-year fixed on a refinance is high 4s, and a 5-year variable is honestly low 4s, low to mid 4s right now. So refinancing only makes sense if it actually improves your situation, your cash flow, total interest, and long-term strategy. Let's have a quick reality check and a quick conversation here, because I really want to talk about the lowest advertised rates you see online. To get those, lenders maybe add a bona fide sales clause, which means you can't get out of it unless you sell your house. There's often restricted prepayments. There's usually a block for midterm switches, or they just make your penalty so brutal. So yeah, you might save like $40 a month, and then life happens. That's where I'd rather see a slightly higher rate with flexibility than the cheap rate that traps you. So before you get all fixed on rate, figure out your next 3 to 5 years and don't get trapped. Now, fixed versus variable. This is how I frame it. A 5-year fixed, you are comfortable with where you're at and you know you're going to stay there for 5 years. You're comfortable with paying for certainty. You want a stable payment. You want zero stress if the rates wobble. If that sounds like you, take a fixed. But if your plans might change in the next 5 years, look at variable. The payment risk is totally cheaper with a variable versus fixed, and there is potential upsides if rates fall further. Now, the 3-year fixed is like the middle ground here. Okay? If you think you might do something but you're not sure, take a 3-year fixed if it makes sense for you. You only have 3 years, your flexibility can be sooner, and just make sure you get good prepayment privileges. And just know you will have a higher penalty if you switch around a 1.5 or 2 years. Now, if you are renewing soon, options create leverage. But if you're switching, don't just chase the rate, read the penalties. And if you're refinancing, make sure your refinance actually solves your problem, not just feels productive. Which means if you want to pay off debt or you want to do a renovation, make it make sense. So for GTA and Ontario buyers right now, insured buyers are finally seeing strong fixed rates again for 3-year fixed. Conventional buyers are close behind and refinancers are paying more, but you should be strategic, like I said. And lastly, again, the 5-year variable is back. It's been back for a while, but it's a calculated decision, not an automatic one. The biggest thing here is, again, which bucket do you fit in? And also, it's not just about which bucket really, like purchase, uninsurable, rental, etc. It's your income. It's your credit score. It's so much. It's not just one size fits all. If you want to know what your options are for a purchase, a switch, or a refinance, click the link below and book a call with me. No pressure. We can have a chat about what your 2026 needs are and goals are, and we can just go from there. So drop a comment below. Are you leaning towards a fixed or a variable? And please hit the like and subscribe button because I would love to hit 10,000 subscribers by the end of 2026. Thank you all for watching. I'll see you on the next one.